I'm Matt Bouchard in San Francisco for NAREIT's REIT World, our 2018 annual conference. Joining me today is Drew Alexander, President and CEO of Weingarten Realty Investors. Drew, thanks so much for joining us.
My pleasure.
Now, in the third quarter, Weingarten made several dispositions, but no acquisitions. Can you talk about what drove those decisions and what sort of activity do you expect for both the fourth quarter and 2019?
Great question, Matt. We remain very active in looking at acquisitions, but things are very competitive for the quality of properties that we want to buy. So, working on some things and optimistic that we'll get some acquisitions done in 2018, focusing on our target markets. As you said, dispositions, we've been very successful. We increased our guidance for the year to $525 to $625 million. And it's really all about the strategy of improving the quality of the portfolio, decreasing the risk. So we've sold 52 power centers, sold centers such that we've reduced our watch list tenants by over 50 names. The TAP score of the average center is 64 and what we've sold is 51. So it's all about improving the quality, decreasing the risk, and we've been able to sell these bottom tier properties at about our net asset value when the stock is at a discount to net asset value, which we think has to be a good long-term approach.
Now, another area where Weingarten remains active is in redevelopment and development. What sorts of trends are you seeing there?
So a lot of what we're doing, we're not doing that much brand new development. We are involved in 2 ground-up projects in the Virginia area mixed use projects that'll benefit greatly if the rumors prove to be true that part of Amazon HQ2 is going in Crystal City, near our 2 projects. So some select new development where we can find the right opportunities. Then we're doing, as you say, a lot of redevelopment. We have one really big project that we're super excited about, luxury high-rise residential at our River Oak Shopping Center in Houston, which is the probably 3rd oldest shopping center anywhere. And we've actually been working for probably about 15 years to add this residential component, and really excited to finally broken ground on that. And then we have a lot of simple, basic adding a building here, re-merchandising a tenant there, that when you add it up, it's about $80 million, 14 projects, pretty simple execution, about 11% return on those. So very good risk reward and a pretty good shadow pipeline to keep those things coming on down the pike.
And lastly, can you talk a little bit about the strength of your tenant diversification and what types of tenants you're actively targeting, and then which types are on your watch list?
So I don't think there's any great secrets of the watch list. We look at all the same reports everybody else does, and have been good about looking at electronics and books and the office supply folks. I think the diversification is the most important thing, and we have the most diversified portfolio in our peer group in terms of what our top 10 represents. Our top 5 tenants include Kroger, TJ Maxx, Ross, Whole Foods, and a great regional supermarket company in Texas called HEB. And at that point, when you get to number 6, we're down to 1.6% of revenue. So it's a very diversified name. And I think that's the main thing that one can hope for in today's world, that retail is ever changing, and diversification is very good for safety and continuity and continued earnings growth.
Great. Drew, thank you so much for joining us.
My pleasure.
For more from REIT World 2018, be sure to visit NAREIT's website, REIT.com.